For those that are joining us tonight, thank you for listening in. Dave, can you hear me all right?
Hear you great.
Okay. So the financial planning industry and clients, investors, savers, they're overwhelmed with the basic concepts of how to pay yourself first and how the power of compounding works in your favor. But I think that the subject matter isn't given its proper due in terms of giving people a mathematical justification, a look at the true mathematical power of compounding, the time value of money, and how to pay yourself first to the point that they truly understand the impact of their choices. I mean, everybody knows if you save earlier, you'd be better off than waiting to save later. Everybody understands if you get a higher rate of return, that's better than getting a lower rate of return. Everybody understands if you put more money in, you'll have more money out. But our goal tonight is to give you a mathematical view of what this looks like. And really all it's intended to do is just give you more motivation to buckle down and prioritize best practices and savings so that you will be able to better accomplish your financial goals, which could either mean at the point that you choose to retire, you'll have more assets to support the lifestyle for which that you want to live, or that you've done such a great job that you have the opportunity to retire earlier and get off the gerbil wheel more quickly than those people who are tied down to try to catch up from decades of under savings. So we're just going to go really through 5 slides, 5 simple slides that when you see them in total, you should be much more attached to the mathematical justification for saving better, saving smarter, saving earlier. This is going to go more quickly than many of our knowledge series presentations because we want to leave time for questions that are related to this topic, should you have any. Also, if you find this information helpful, if you find this information motivational, then perhaps we can do this again so that we can speak to a wider audience. And we would then ask for your help if you feel that the presentation was helpful to you to spread the word and bring more younger savers into the conversation. And we could set up a 2.0, just do it a second showing on another evening because it's so easy, it's so fun, it's the right thing to talk about. So, time value of money. We're going to start with the most basic of all presentations, which is just a straight up mathematical example of the power of compounding. Nothing you don't already know. After we go through this slide, we'll expand on it and show you some of the ramifications and implications of the power of compounding, or some of the variations of the power of compounding. So here you see a chart. You can read it for yourself. Column number 1, this is an illustration of putting $800 a month away into a savings vehicle. Whether that's 5% of your salary or 8% of your salary or 12% of your income, it's just a number. Then we graduate that monthly payment to show you $800 a month versus $1,000 a month, finishing with $1,200 a month. So the $1,200 a month, if a young person is making $120,000 gross income and was participating in a 401k and had an employer match, that might be somewhere around 11-12% of your income. So all of these numbers are realistic for people who are in the workforce and generating a reasonable income. So you have your monthly payment, the second column IRR, is just an acronym for internal rate of return. This is just your rate of return on your invested assets. And then the amount of years that you're compounding. So a 33-year-old, 20 years gets them to 53, 55 when you're starting to think about the possibility of early retirement. A 35-year-old who compounds at 30 years is someone who's retiring just before their Social Security benefits date. So these numbers are reasonable. The duration of years are reasonable. And then the monthly payment multiplied by the amount of years is the total contribution that you put in. And the next column is the future value of that portfolio. And then we identify the total gain that investment is made for you, that the market has paid you for growing your assets. And then the last column is the multiplier that created. So someone who's 40 years old starts contributing $800 a month on the first line, gets 6% rate of return, grows that portfolio, makes that contribution for 20 years, putting them at age 60, which would be considered early retirement according to Social Security. So you put in $192,000 of capital and the future value is $369,000. So over 20 years, starting at zero, you've almost doubled your money. You've had a 2x multiplier of your account. You put in 192 and Mr. Market gave you 177. That's a terrific result, but that's only at 6%. So imagine that same investor is able to put a little bit more engine into their portfolio and averages 8% under the same circumstances. You put in the same amount of money, 192,000, but now the portfolio is up to 471,000. So just by posturing your portfolio more for an 8% gain on an annual basis rather than a 6% gain, only a 2% a year differential, you've picked up an additional $90,000 over the investor who only received 6%. And now your multiplier on that portfolio gain is 2.5 times. The next investor raises their monthly savings to $1,000 a month, gets 8% and does that for 30 years. You've put in 360,000. Now your portfolio is worth just shy of 1.5 million. So you put in $360,000 in capital over 30 years, and Mr. Market has given you 1.13 million of growth. That's a 4x multiplier on your capital contributions. You have the same scenario here, but the person does it for 34 years. So that would be someone who's 33 and retires at 67, right at the time that your Social Security has hit full benefits. You put in 408,000. Now your portfolio is over $2 million. That's a 5x multiplier on your assets, which means that the market has given you essentially $1.7 million in portfolio growth. And of course, the last one is $1,200 a month, earning 8% for 34 years. You put in $489,000 of capital. Your future value is 2.5 million. So Mr. Market has given you $2 million in growth, which is a 5.2x multiplier on your assets, on your contributions rather. So this story just gets better and better and better. And the power of compounding is epic, as you can see it in this easy table. So it's somewhat self-evident. You give it time, you invest for growth, you commit to your contributions and your savings rate, and you will be extremely well rewarded. So here I have in the footnotes that the reason why I put an increase from 6 to 8% to show you the profound effect that will be achieved or realized if you can get merely 2% more a year on your investments speaks to and supports our advice to younger investors to committing to a growth only portfolio strategy, at least until you're 50. Fixed investments, guaranteed investments, risk-free investments in this low interest rate environment. And yes, it's still a low interest rate environment. The only thing they do is give you peace of mind once in a while, but you'll only get 3% on a fixed investment. You want to hitch your wagon 100% to growth. So you look at your 401k options, you look at your own brokerage savings options. There's no need for fixed bonds or annuities or CDs in your long-term growth portfolio. You want to hitch your wagon to companies that, in which you can take equity ownership that are growing 10, 15% a year. Microsoft just came out with their earnings. Visa, Chipotle just came out with their earnings today, and they're growing 12, 13%. You want to own pieces of those businesses so you can grow your portfolio at 8% or more. So growth only. Look at your investments and make sure you don't have anything holding you back. Forget about volatility. Volatility is not your enemy when you're a young investor. It's actually your ally. And the second issue is when you increase your savings from $600 a month to say $1,000 a month, that speaks to the concept of paying yourself first. Consider your future savings, your retirement bucket, whatever. Consider that a mortgage. You're mortgaging your future investment portfolio, and you're going to make that mortgage payment come hell or high water, and you're going to do it first because it's a debt that you owe to yourself. We are in a procrastination world. We're in a consumption world. So most people consume what they want to consume and save what they have left over. And we like to get people to flip that over and put yourself down to save 10% of your income or better first, and figure out how you're going to budget yourself with the remainder. If you do those two things, invest for growth only for the next 20 years, and make sure you pay yourself first before you pay other bills, you're going to achieve these numbers. And this is just spectacular. If I had done what I'm preaching when I was 30, I'd be a lot better off today, but I have a plan to make up for it. So, but these multipliers are just terrific. And that's really the bottom line. So that's the straightforward way to look at it. Now we're going to flip over to a slightly different angle at the same exercise. This slide just tells you what's your cost of waiting. What if you just say, I want to travel, I want to have fun, I want to get an expensive apartment in Manhattan or Austin, Texas, or San Francisco. I don't want to live in an austere life and, minimize my amenity, keep my amenities in check. I want to live well. So I'll start saving when I'm 40. Oh, well, I've got new child, new children, new house. I'll start saving when I'm 45. Well, then I'll really buckle down when I'm 50. What's the cost of waiting? So we put that in a chart, and the question to solve is, how do I get to $2 million? So this just shows you in column 1, the goal for each row is to get to $2 million. The internal rate of return on your portfolio is the same. Everybody's getting 7%. And everybody is looking to retire at age 67 when they hit their full Social Security benefits. So row 1, the 32-year-old the person starts saving at age 32 and has 35 years to accomplish their goal. To get to $2 million, they need to put away $1,100 a month, which would equate to a total deposits over that 35 years of $466,000. A 35-year-old who's trying to accomplish the same goal just by waiting 3 years, now to hit 2 million, they need to put $1,400 a month away. That's $300 more a month to get to the same 2 million. And because you waited 3 years, instead of putting away 466, you have to put away 537. So now your outlay is $71,000 more to get to the 2 million than someone who started merely 3 years later. Someone who starts at age 42 to hit the 2 million, they have to put away $2,500 a month. The 49-year-old has to put away $5,600 a month. We won't even go to the next row because that's just embarrassing. So imagine the cost of waiting a 32-year-old to a 42-year-old. You have to put in more than double the amount of money, $1,100 a month to $240 a month, just to get to the, I must have calculated this incorrectly, but the increase is significant. This is correct. So you wait 10 years to get started, you have to double the amount of money away per month to get the $2 million. So this is the cost of waiting. It's important. Time is on your side. Get to it early. All right. So now we've looked at we've had two different looks at just the pure power of compounding through the front door of just being excited about how you can leverage growth, and looking through the back door at, what's my cost if I wait to get started to save in earnest. So now we're going to change this up. Where do most young investors save? They save in their company employer sponsored plan, where you have matching contributions and such, and tax savings from those contributions. So we're going to give you a little bit broader of a view of how powerful these employer sponsored, company sponsored retirement plans are, by looking at through the lens of what we call retire on other people's money. Other people's money, that's the key. Leverage it by using other people's money. So let's first start at the bottom. I'll increase the font a little bit. What are the what are the inputs here? This is an example of someone who has $40,000 a year of income. You save 10% of that income in your 401k. Your income tax rate is 25%. Your employer matches 50% of your contributions up to the first 6% of earnings. 50 cents to the dollar up to your first 6%. So you'll be getting, in effect, a 3% match. And the average rate of return on your portfolio is 7%. Now let's look at the columns. Excuse me. Whoops. Switch slide. My apologies. All right. So Dave, I see the our guests on the right on this black bar. Can you see the whole spreadsheet, Dave?
Yes, you can.
Okay. So column number one are the amount of years that you're saving. You're saving $4,000 a year. So the second column is your cumulative contributions coming out of your paycheck. And because you're contributing enough to get the full employer match, that is outlined here in column 3. So this is the amount that your employer puts in for you. Then, if you're doing it on a pre-tax basis, then you get a tax deduction for those contributions that you put in. In other words, it'll result in having a lower tax outlay. So that is directly equivalent to a savings. So Uncle Sam is contributing this amount for you. So in year 1, you put away $4,000. Your employer is going to add $1,200. Uncle Sam is going to save you $1,000 in taxes. So your net contribution is only $3,000 after you factor in the tax savings. This column shows you the growth of your portfolio at 7%. This shows you the total balance of your 401k. This column shows you the total return that it was generated on those assets when you incorporate other people's money. So you have your own here. Column 2, you're putting in $4,000. Other people's money is your employer adding $1,200, the IRS giving you $1,000 of savings, and the market growing at 7%. That's other people's money. So just take a look at a 33-year-old who retires here 30 years later at age 63. So that employee's put in $120,000 of their own money, but your employer has added 36. The tax savings from the IRA amounts to 30. The market growth on your portfolio is 335. Your 401k balance is a little shy of $500,000. So you put in 120, but your account is worth 490, and a vast majority of that is other people's money. The market, your employer, and the IRS giving you the tax savings. So this idea of retire on other people's money, it seems almost glib in a way, but it's very powerful. And the one caveat here is people might say, well, that tax savings isn't real. If the IRS gives me $1,000 of a tax break, I don't add that $1,000 to an account, but you could, particularly if you get a refund. If you add an amount to your 401k that is so robust that you end up getting a $500 or $600 or $1,200 tax refund, why not put that in a Roth IRA? Why not put that in a brokerage account so you can buy shares of Chipotle and Microsoft and Visa and grow your money at 10% a year? So it can be real. If it gets swallowed up in the regular budget part of your life and you don't harvest those tax savings, then it's not as epic, but it's there. It's real. For every dollar you put into your 401k, you're getting a 20-cent or 25-cent rebate in the form of a lower taxes. So we illustrate this when we go to 401k enrollment meetings. We manage a bunch of 401ks and we sit down with employees. We try to get them to understand the power of the leverage you get by getting an employer match, a tax deduction, and tax deferred market growth on your contributions. And when you add that all in, it's you can't grow money faster. And so I guess the message here is make sure that if you are in your employer sponsored plan, that you contribute enough to at least get the full match from your employer. Okay, so up to this point, the only thing that we haven't talked about is the tax status of all this growth. because the cynic might come in and say, okay, I'm 70 years old here and I've got $1 million in my 401k, and that's going to generate $72,000 a year in income, but I have to pay income tax on that. So it's not as great as it seems. Well, one answer is, well, that it is what it is. You live in a country that assesses taxes and there's nothing you can do about it. So you pay your taxes, you try to minimize it, and you live on the difference. But that's not the end of the story. There is a vehicle called the Roth IRA or the Roth 401k, in which you can accumulate assets that grow tax-free and are paid out to you tax-free. So we're going to kind of finish up with this slide about Roth contributions, the power of the Roth. And we're not going to overcomplicate it. It's very, very simple. If in this example, you put away $500 a month, compounding at 8%, and you do this for 30 years. Now, this Roth can be accomplished in an individual IRA, Roth IRA, or it can be accomplished in the 401k Roth sleeve in your employer plan. And even if you're in the TSP program or a municipal 457 retirement plan, they will, or a nonprofit 403b plan, they all have Roth elections to it. So this should be ubiquitous in terms of finding a retirement account that would allow you to accumulate Roth savings. So here, again, $500 a month, compounding for 8% as an annual return for 30 years. You can see here on this chart that if you go over to the left axis, your total capital contributions are, about $120,000 over that lifetime, but the account value is $720,000. So all of this growth that's in green, from 150, 120, I don't have the exact number, Steve might know. You put in 120, it's worth 720. So you have $600,000 of growth, and every nickel of that will come out tax-free, every nickel. In fact, every nickel of all of it, because your contributions are tax-free as well. So the question here, people fight. We spend every week talking to people about whether it's more efficient to do it pre-tax and get tax savings this year and next year and the year after, but grow the pot of money and pay taxes when you pull it out? Or is it better to forego a tax deduction now to accumulate money in a Roth so that when you withdraw it during retirement, it's tax exempt? Well, I think this chart kind of blows that out of the water by asking this simple question you see here over on the right side. And this is not our verbiage. We stole it from something we read, but we think it's spectacular. Would you rather pay taxes on the seed, or would you rather pay tax on the harvest? Here, you're paying tax on the seed. The 120,000 you put in is after tax money, but you don't pay any tax on the $600,000 harvest, not a nickel, not state, not federal. That whole block of money comes out tax-free and grew tax-free. If you invert it, you could say, well, I'd rather pay tax on the harvest and save money on the seed. So you put this money in year after year, you get a tax break, but all of this growth of $600,000 will be taxable to you when you withdraw it. And if tax rates are higher when you're in your retirement, then you'll wish that you had pursued a different course. So all of these wonderful things about accumulating assets here. None of this speaks to the tax status. It just shows you the raw absolute numbers, and it would be spectacular over your lifetime to put in 489,000 and have it grow to 2.5 million. But if you did that in a Roth and that $2 million of portfolio gain could be pulled out tax-free, then you're going to make all your friends cry for not having done the same. So the power of Roth is something that has to be front and center for young investors, young savers, so that you can not pay tax on the harvest, which in this case is $600,000. So wrapping it up, how do you put yourself first? What behavioral and logistical things can you do to make sure that you could save at the rate that would give you all these spectacular numbers? Well, as we just mentioned, contribute to your employer-sponsored plan at least up to the full extent of your employer match. Number 2 tip, enroll in the auto increase at your employer. Most employer 401ks have an auto increase that if you were to subscribe to this feature, every year your 401k contributions would be bumped by 4%. And you can always opt out of it if you realize that you're overextended. But this way it's automatic, and then it happens and you forget about it and you worry not, and you just manage the budget that you have. And now you're increasing your contribution by another 4%. And if you don't have auto increase, then you just need to manually make a pledge to increase your contributions each year, particularly if it coincides with an annual raise or an annual bonus. So if you're under 50, the 401k max next year is 19.5. So you get to mid-December or late November, and you've put in $10,000, but you know the max is 19, and your employer is giving you a $10,000 bonus. Put 2,000, 3,000, 4,000 of that bonus in your 401k on the Roth side, and contribute 12% of your income instead of 8%, and use the rest for amenities and your trip to Vail or whatever you're going to do. So enroll in auto increase or figure out a way to do it manually. Third, open up an after-tax brokerage account with Fidelity, with Schwab, with Vanguard. And they all have automatic money link features that would replicate the auto contribution that you get in your employer. So you set up the brokerage account and just set up an automatic monthly transfer, $100 a month, $50 a month, $200 a month. And in almost every case, you can set up investment funds that will auto invest those contributions, so that the day the money hits, you're automatically buying shares of a growth investment. And that aspect of it is also automated. You're not going to sit there and accumulate cash and find out that you missed the bottom of a correction and you could have put the money to work. It just auto invests. Number 4 is just to commit a savings, a certain percentage of savings for every windfall that you get, a tax refund, an annual Christmas gift from your family, take exercising options grants, revenue from a trust fund. I don't know, anything that you get that's outside of your regular recurring income, decide that you're going to put 10% of that away as well, just like it was earned income. Put it into the brokerage account. The next tip is, if you are a chronic tax refund person, you have a W-2 job, you're not self-employed, and you picked a particular withholding, but at the end of the year, you chronically get a $2,200 refund, don't give your money to Uncle Sam for a year. Lower your withholding to try to make your taxes neutral. That'll increase your take-home pay, and then use that increase in your take-home pay to add to your 401k or to make contributions to your private Roth IRA, or to add it to a brokerage account where you can invest more dynamically. And then the last tip, which is really important now, set a base rate of saving, employer plan, personal accounts, or both. Set a base rate of savings. But if you get into a meltdown in the stock market, such as we have had in January, February, March, and April, increase your savings rate during those down periods so that you can buy more shares of the growth investments at a lower price. And then as the market starts to recover, dial it back. So this is just a way of saying, commit more money to your growth investments when the prices are down, because they won't be down for long. They'll get back to their growth trajectory. In every 5-year cycle, you have 2 years where the market produces spectacular returns. You have 1 year that the market produces decent returns. You have 1 year where the market has flat returns, and you have a 5th year in which the market is damaging like it is now. You put that all together, every 5 years, you're going to have a fantastic return in the market. So when the prices are low, you want to increase your savings rate, even if it's for 3 months. So if you're adding 200 a pay period during normal times and the market gets clobbered, increase that to 300 a pay period and do it until the market recovers, and then dial it back. So contribute to your employer plan, at least to the match. Try to enroll in auto increase or do it manually. Establish an after-tax brokerage account and do the same automated savings, even as low as 50 a month will work. Make sure you put away some of your windfall resources into savings. Lower your tax withholding if you're getting a refund, so that you can put that money to work and not wait till May of the following year to get that check in your hand. And just be sensitive to the market to put in a little bit more when the prices are at a discount. And if you can do those things, then all these wonderful numbers can come true, and you can either lead a healthier retirement than your peers, or retire early and spend the rest of your days learning how to oil paint or how to sail and lead a better life.